Hello, my name is Stuart Patterson and I'm the fund manager of the Tiburon Taurus fund. Tiburon Taurus is an Asia-Pacific ex-Japan equity long short fund. The fund is a UCITS fund offering daily liquidity. The underlying portfolio of the fund matches the liquidity terms that we offer to our investors. The philosophy behind the fund has its origins in our observations of the behaviour of Asian markets over the last 30 years or so. And there are a number of observations that come to mind and dictate the process that we operate under. The first of those would be that the asset class has been so volatile over that period that producing good information ratios as an investor has been nigh on an impossible task because the volatility has been so high. And one of the aims of the fund is to crunch the volatility of the market to about a third of the underlying level. The second observation we would make has been that the returns have been very lumpy, that the region tends to go through big re-ratings and de-ratings, most of which occur with a macro explanator behind them. That volatility really has its origins in two underlying factors. The first is that the developed world has outsourced much of the manufacturing in its economies to Asia, as Asia has become the factory of the world. And by its nature, manufacturing tends to be a much more volatile undertaking than the other constituent parts of GDP. The second observation I would make is that by and large all Asian central banks target their exchange rates to some degree or another, and in doing so they abrogate responsibility for their monetary policy, and so the region in effect inherits a monetary policy from the Federal Reserve and the United States. Now, needless to say, the United States sets its monetary policy in accordance with its own needs and requirements at any particular time. And therefore, if monetary policy is appropriate in Asia, it's purely by accident. So this combination of inherently volatile economies coupled with inappropriate monetary policy leads to very violent re-ratings and de-ratings of financial assets, and in particular equities. And what the fund sets out to do is to deploy a macro-driven process to exploit these de-ratings and re-ratings to generate mid-teen returns per annum for our investors over the course of a market cycle. Now, the process really has three elements to it. The first of these is what we call exogenous macro, and what that involves really is putting the region in a global context. Obviously, trade is very important to the region, as are capital flows both in and out of the region in determining the direction of financial asset prices. And so in our view, investing in the region without a global context is potentially a recipe for disaster. So this exogenous macro analysis tends to focus on US monetary policy, growth, exchange rates, commodity prices, and the various other factors that will impact the economies and financial markets of the region. The second part to the process is what we call endogenous macro. And what we're really doing there is looking at the countries within the region and the sectors within the region and asking ourselves the question, how might these various markets perform in a way that's different from the way they've performed in previous cycles because of the ongoing changes that are taking place within the region. The most obvious example, obviously, over the last 15 years or so has been the tremendous rise in importance of China. Just 20 years ago, China represented 1% of global GDP. It now represents 12% of GDP, and therefore has the ability to influence not only its own market, but the region as a whole, and even, of course, some global factors as well. So the third element really is boiling our macro views down to the stock level, and we do that through valuation work. And what we're really setting out to do through the valuation work is deduce where market expectations are, and then comparing those to what we believe the most likely macro outcomes will be. And through that matching process, look for price anomalies where we believe we have a very different set of expectations from what the market is discounting. So those are the three elements of the process: the endogenous macro, the exogenous macro, and then the valuation work deduced at answering the question, where are we different from the market? From that process obviously stems a number of investment opportunities on the long and the short side, and the fund tends to invest in baskets of stock, collections of stocks that express our views at the country and sector level. We're not actively seeking to take too much stock-specific risk. We're looking to express those macro views in the equity markets. So in summary, the fund is an Asia-Pacific equity long-short fund with a very macro-driven process looking to exploit the big re-ratings and de-ratings of the region that occur with macro fundamentals. And the fund sets out to offer daily liquidity and to offer a mid-teen return per annum over the course of a cycle for a volatility of about a third of the market's volatility.